Before I jump on to the topic of this session, I would like to throw some lights into the past, where old revenue recognition standards were applicable. There were big accounting frauds happen in that era, which has become history now. For example, Enron Corporation in USA and Satyam Computers in India, where the key accounting frauds in those companies include revenue accounting manipulations. Through fraudulently inflated revenue, those organizations were able to show a hyper financial position, increasing working capital position, gearing level, and followed by other reporting frauds, which finally led to collapse of those companies more than a decade back. Those accounting fraud of old days was one of the key trigger points to have a joint project from IASB and FASB, which has resulted into a new accounting standard towards revenue recognition. That's not all. There is a global effort to converge accounting standards as well, with the aim of achieving consistency between IFRS and US GAAP. As a result of which, IFRS 15 was developed as part of the joint effort between IASB and FASB to converge their respective standards on revenue recognition. Hope you have excited now to cover this most recent and quite popular accounting standard. This is one of the transformative accounting standards that has left an indelible mark on the financial reporting landscape. It is IFRS 15, which talks about revenue recognition in all aspects. What if you could hone your skills in IFRS 15 so that you can be a subject matter expert in this standard and can grab great opportunities in the accounting profession? For example, taking over assignments or project in complex financial reporting scenario on revenue recognition. And that's not all. It will help you to understand core financial concepts that would be relevant in other accounting areas as well as getting discussed in this channel. I'm quite excited to take you on this journey as IFRS 15 has challenged us to move beyond the mere mechanics of accounting and embrace the true essence of revenue recognition by capturing the economic substance of transactions. In this session, we will be starting our discussion with some background of this most admired accounting standard, covering the scope of IFRS 15. The five-step model for revenue recognition will be discussed one by one, followed by other specific topics and relevant disclosures. In the specific topic, we will be covering of some special transactions getting discussed within IFRS 15 towards revenue recognition. Kindly note that this standard was written by IASB along with FASB as a joint project, which has resulted in minimizing differences with its US GAAP counterpart, that is FASB ASC 606. In the world we inhabited before IFRS 15, there were multiple accounting standards dealing with same topic in different forms. In those days, the path to accurate revenue recognition was fraught with challenges, where different interpretation led to different results many times, throwing a challenge towards transparency and comparability of financial statements. As a beacon of hope, IFRS 15 a standard that brought clarity, consistency, and comparability to previous chaotic world in accounting of revenue recognition. With effect from January 2018, this standard replaced those old standards like IAS 18 revenue, IAS 11 construction contract, and other industry specific standards and publications as listed on this screen. The standard IFRS 15 applies to all situations, with some exceptions, where we need to follow other standards covering some niche areas like lease contracts, insurance contracts, financial instrument transactions, right and obligations related to group of consolidation, non-monetary exchanges between entities in the same line of business. So those are specifically dealt by other standards. It is worth to note as well that IFRS 15 applies only to contracts with customers, not with other parties. For example, pharmaceutical companies collaborate for development of drugs. In this situation, they act as collaborators and not customers. Another example could be oil and gas companies doing cost sharing arrangements for high capital intensive advanced technical research projects, where individual entities or companies here act as cost sharers, not customers. The core principles creating a backbone for the standard IFRS 15 involves recognizing revenue as and when an entity transfers goods or services to its customer, and their amount of revenue recognized reflects the consideration the entity expects to receive for those goods and services. This principle is achieved through a five-step approach that must be followed in order to recognize revenue. Now, we will walk through the five-step approach to recognizing revenue. The first thing to do is to determine if there are contracts, and that seems quite simple and straightforward, but it has changed some revenue for businesses because previously they might have had minor income streams like income from licensing and intellectual property fees, etc. The companies those days record those in other income towards bottom of the P&L, and these incomes come from a contract, so now it must be included within revenue. The second step is to identify the performance obligations within that contract. And a company like Siemens AG, for example, might have a contract that says sells an equipment for steel melting shop, installs that equipment at customer site location, and trains staffs to use that equipment at customer premises. Well, that could have three performance obligations, and a company would have to look at that because there is going to be a revenue recognition element that is different for each of those. The third step is to look at the term that is contract price or transaction price. Now, many contracts there could be variable components. For example, Emirates in airlines business might be having compensation for flights getting delayed or cancelled for some reason, and that would be known as variable consideration. And if that's the case, the company have to account for what is the probable amount of variable consideration that will not be recognized. For example, uh, Emirates Airlines giving some compensation would actually be reduced from their revenue rather than recorded as a separate expense. The fourth step is to then to allocate the transaction price to the separate performance obligations. Going back to the example of Siemens AG having a contract for sale of equipment, installation of it, and staff training, the company have to look at the total contract value and then maybe allocate an amount that goes to sale of the equipment, some amount goes to installation of the equipment, and few amounts to the training of staffs, etc. This requires a bit of working for measuring the amounts for individual performance obligations. The fifth and the final step is to actually record the revenue as and when the performance obligations are satisfied. So the day the company delivers the equipment, it has to recognize the revenue on that part. The day the company turns on and installs the equipment, it must recognize the revenue on that part. And lastly, the revenue for training of staffs should be recognized in the period when the company finishes the training, and if it is going to take a significant period of time based on contract terms, then the company is likely to be able to recognize revenue on that over time. As we discussed, the absolute essential thing that this standard IFRS 15 has done is that it gives a five-step approach, which is aimed to give companies a lot of guidance on more complex contracts and transactions, to when they can recognize revenue and actually how much revenue they are allowed to recognize. The first step towards revenue recognition includes identifying the contract with customer. Although it seems to be very straightforward, but it has multiple aspects around it, such as parties to the contract need to have approved it. The contract must have commercial substance, and the right and obligation of each party as well as payment terms should be identified. Although the contracts can be written, oral or implied, IFRS 15 will only apply when all these criteria are met. The parties to the contract have approved it and are committed to perform their obligations. For example, in case of situation where you are entering into a shopping mall for buying some commodities, the shopkeeper is eager to provide you the required goods. This situation shows an approval and commitment in both the sides, resulting into an implied contract. The next is entity can identify each party's right regarding the goods and services to be transferred. Contract must have the commercial substance. In the absence of commercial sense of the transaction, it cannot be treated as revenue to the entity. Entity can identify the payment terms for the goods and services. And lastly, it is probable that the entity will collect the consideration to which it is entitled to. Going back to the example of you are visiting a shopping mall, the sellers over there managing multiple shops are aware of the goods and services that are going to be sold to you, the pricing of it, the mode of payment, and the overall essence of the transaction. So that shows an implied contract, and that could be a valid revenue transaction. IFRS 15 focuses us to think about bundling and unbundling of contracts with customers as well. An entity should combine multiple contracts entered into at the same time with same customer if one of these criteria apply. The contracts are negotiated as a package with single commercial objective, or the amount of consideration to be paid in one contract depend on the price or performance obligation of other contract, or the goods or services promised in the contract are a single performance obligation. An example of combining contract may be an internet service provider or Wi-Fi provider who also provides television services over the same period with same network connection as a combo plan. There may be officially two contracts, but they are for the same customer, delivered as a combo service, and the price paid is dependent on whether both the services are purchased or not. In this situation, the reporting entity should combine multiple contracts. Once we have established whether there is a contract with customer or not, we then need to identify the separate promises within that contract. IFRS 15 provides to consider how many promises are included within a contract and if they are distinct or not. The separate promises within the contract could be one, two, or more than that. Please note that the performance obligation can be implied or implicit as well, based on customary business practices like warranties that is usual to provide by the seller in some situation in some markets. Let's take an example of here from telecom industry. Say Vodafone, if a customer visits a mobile phone store, the company Vodafone might sign up for a cell phone under postpaid scheme with a contract to provide network provision for a period of time often 24 months. And that is typically that no cash would exchange hands on signing the contract. The cell phone is often described as a with the contract, but there is a strong argument that this is not free. In fact, the cost is factored into 12 months contract. If other criteria is met, the telecom provider should recognize the revenue from handset on the day 1 and the network provision over 24 months period. Now let's move on. What is the criteria for distinct goods or services? IFRS 15 says that in order to consider a performance obligation distinct, we have to consider criteria like the customer can benefit from the goods or services on its own or with readily available resources, and the entity's promise to transfer the goods or services to the customer is separately identifiable. In essence, the goods or services must be distinct from the point of view of customer and the provider. If a construction company is being asked to construct a building for a customer, it could say that as a business, it separately supplies bricks, construction labor, and provides interior, etc. However, from IFRS 15's point of view, the customer has requested a building to be created, and therefore the bricks, construction labor, and interior supplies are merely inputs into that process. The promise to supply bricks is not separately identifiable from the promise to construct a building, and the customer can only get benefit collectively as a building getting constructed. Therefore, there is no separate performance obligation here. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of a third party. There are many things to consider in terms of transaction price. The same transaction might be valued differently depending on the entity, and we must consider the contract terms and customary business practices. For example, whether discounts are customary, etc. Transaction price shall exclude the amount collected on behalf of a third party. The commission income should be accounted for correctly by excluding amounts collected on behalf of the customer or clients. Here it is worthy to recall the accounting fraud case of Enron Corporation. The company Enron, once most celebrated energy giant in USA, inflated its profits through a complex wave of accounting fraud almost 2 decades back. Among other things, Enron had overstated its revenue by those days by including artificially inflated commission income from its trading activities. The fraud eventually led to Enron's dramatic collapse almost 2 decades back, exposing flaws in old accounting standards and highlighting the importance of accurate and transparent revenue recognition. Moving on to the next point, considerations should be adjusted to reflect the time value of money if the amount of payments provides the customer or entity with a significant payment benefit of financing for more than 12 months. There should be a commercial substance to the transaction. Entities may swap asset instead of paying for a good or service. In order for this to be within the scope of IFRS 15, there need to be commercial substance to the transaction. The transaction price should ideally be based on the fair value of goods or services received, but if that cannot be reliably measured, the standalone selling price is used. If the standalone selling price cannot be reliably measured, no revenue or cost of sales is recognized. Variable consideration is not fixed and is therefore uncertain. When considering whether a performance bonus or a potential volume discount should be reflected in the transaction price, IFRS 15 states that variable consideration is estimated and only included in the transaction price if it is highly probable that it will not be reversed. IFRS 15 says that variable consideration should be adjusted using one of the two methods. First is expected values. This is appropriate if entity has a range of contracts with similar characteristics and quite possibly imperial data to support the estimate is available. Next is most likely value. This is the single most likely amount and is normally used if there are only two outcomes. For example, a performance bonus for submitting a report by a particular date will either be received or it will not be. When deciding whether or not to include variable consideration, IFRS 15 asks us to consider the likelihood and magnitude of the revenue reversal. IFRS 15 states it is fine to include part of the variable consideration. When assessing the likelihood and magnitude of revenue reversal, the following should be considered. Length of time before uncertainty is resolved, how much experience the entity has with similar contracts, large number and broad range of possible consideration amounts, the amount of consideration that is suspectable to factor outside the entity's control. Use of judgment and consideration of all the facts and circumstances is required. The position may change at each reporting date as more information becomes available, and there is a greater certainty about expected amount of consideration. If we think of some practical scenario here, say a software company enters into a licensing agreement with a customer to provide access to its proprietary software for a fixed license fees and an additional sale-based royalty. The term of agreement states that customer will pay a fixed license fees upfront and a sale-based royalty on all future sales generated using the licensed software for the next couple of years. Here is how you might apply the variable consideration accounting treatment for sale-based royalty on future sales to be generated by the customer. The software company in such a case may follow either expected value method or most likely value method for such variable consideration included in licensing agreement with due consideration to the magnitude of the revenue reversal. Once the transaction price is finalized, it needs to be allocated across separate performance obligations. Ideally, this would be done based on the standalone selling price, but that might not always be observable. If the standalone selling price is not observable, then IFRS 15 suggests the alternative methods. Expected cost plus typical markup. Second method would be suggested market assessment. This is to adjust based on the competitors' prices. Then the next is residual approach. Use standalone selling prices for performance obligation known and the balance of transaction price is allocated to the remaining obligation. Now, going back to our earlier example of Vodafone, if a customer visits a mobile phone store, they might sign up for a cell phone handset under the postpaid scheme with a contract to have network provision for a couple of months. The company Vodafone should allocate the transaction price to two separate performance obligations involved here. That is, sale of goods, that is, sale of mobile handset, and second is network service coverage. Moreover, if the price of either of the promises is not identifiable, then the company can go for either cost plus markup or current market price or residual approach. The company should recognize revenue when or as it satisfies a performance obligation by transferring a promised goods or service to a customer. IFRS 15 focus on control as the indicator of a performance obligation to be satisfied. In order for control to be transferred over time and therefore revenue to be recognized over time, one of these criteria should fulfill, such as customer simultaneously receives and consumes the benefit as the entity performs, the entity's performance create or enhances an asset that the customer controls as the asset is created or enhanced, the entity's performance doesn't create an asset with an alternative use to the entity, and the entity has an enforceable right for payment for the performance completed to date. If the revenue is to be recognized over time, IFRS 15 offers two methods to measure progress. This is a choice, but should be applied consistently across performance obligations. Input method, which includes considering labor hours, machine hours, time lapse, cost incurred to date, etc. Second is output method, which includes milestone reached, which could be the example of real estate construction contracts, or the other output methods like unit produce, survey of performance to date, etc. Imagine a software development company enters into a contract with a customer to develop a customized software solution. The contract specifies the development of the software, its implementation, and post-implementation support for a couple of years. Say the software development and implementation is getting completed in the first year and the customer is accepting it after taking it up, then the company may recognize revenue for that part. In subsequent period, the post-implementation support revenue will come, and it would be treated over time based on the criteria like customer is receiving the support, etc. In such a case, the performance delivered over time shall be recognized over each accounting period based on methods like man-hour spent, etc. After discussion of the individual steps and the principles behind estimates and judgment in the individual steps involved in the revenue recognition, it's time to have a check on some special transactions that entity may encounter while recognizing revenue. And lastly, we will be also be discussing about disclosure so required as per the standard. IFRS 15 provides specific guidance for contract cost. There are two types of cost that we need to consider here, which are cost to fulfill a contract and cost to obtain a contract. Cost incurred to fulfill a contract are recognized as asset if and only if all these criteria are met. Costs are related directly to a contract or a specific anticipated contract. Cost generate or enhance resources of the entity that will be used in satisfying performance obligation in the future, and costs are expected to be recovered. On the other hand, costs to obtain a contract are the incremental cost incurred for the contract which would be capitalized and amortized following its pattern of recovery. These are the costs which could not have been incurred without obtaining that contract. For example, sales commission paid for acquisition of customer, legal fees associated with preparation of the contract, bonuses provided to employees specifically to obtain the contract. There could be industry specific cases like a telecom operator paying a huge agency commission to obtain a contract, say for 5-year license to operate. Then the cost shall be amortized over the period of 5 years. Sale on return basis. In case of sale on return basis, an estimate should be made for the amount of goods expected to be returned. The most likely amount of return can be determined by past experience or by assessing probability to estimated figures. For the goods expected to be returned, sale is not recognized. A refund liability is recorded with the amount. The right to receive inventory with a corresponding adjustment to cost of sales should be made. If the items are ultimately not returned, then it will be recognized as the sale at the point of confirmation of no return. The revenue recognition varies when goods and services are dealt as principal or as agent. If the entity is acting as an agent, then the revenue recognition shall be of the commission amount, whereas the entity owning the risk and the reward of the goods or services shall recognize gross amount as revenue on a sales transaction. The principal, usually the entity who fixes the price, takes inventory risk and contract fulfillment responsibility. Consignment arrangements is a transaction where a product that has been delivered to another party may be held in a consignment arrangement if the other party has not obtained control of that product. Bill and hold arrangement. Bill and hold arrangements are those whereby an entity bills a customer for a sale for a particular product, but entity retain physical possession until it is transferred to the customer at a later date. Repurchase arrangements. A repurchase arrangement is a contract in which an entity sells an asset and also promises or has the option either in the same contract or in another contract to repurchase the asset. All these are tested based on the criteria whether the control has been passed on to the customer or not at the time of revenue recognition as per IFRS 15. A license establishes a customer's right to the intellectual property of an entity. If a license is determined to be distinct, account for it as separate performance obligation. If the license is not distinct, the account for it within other promised goods or services as a single performance obligation. The entities must determine the nature of the license in order to determine the revenue recognition pattern. There could be two patterns, right to access, right to use. If the license is a right to access, revenue allocated to the license is recognized over time. If the license is right to use, revenue allocated to the license is recognized at a point in time only. Moving on to the other special transaction, that is warranty. In case of option to purchase extended warranty, that is purchase warranty separately by the customer is there, then warranty is distinct. This should be recognized as a separate performance obligation. If a customer doesn't have the option to purchase warranty separately, on the other hand, an entity shall account for the warranty in accordance with IAS 37, that is provision, contingent liabilities and contingent assets. To help investor better understand the nature, amount, timing, and uncertainty about revenue and cash flows, IFRS 15 provides a company to disclose qualitative and quantitative information about performance obligation, revenue recognized, disaggregated into appropriate categories, that is geographical market or type of customer, contract balances, significant judgment, asset recognized from cost, etc. With this, I am signing off for now. Thanks. Goodbye.